Beijing says no bailout for Evergrande because we're going to break you up. The Fed's talking taper, but is it just talk? Is the housing market starting to slow down, or buyers getting ready to line up to make another big run? Answer those questions and more on today's show. I'm your host, Steven Van Metre. Thanks for joining me today because we continue with a story about Evergrande because the market's acting like it's no big deal. They don't see contagion, but there's a serious issue here because the real estate market in China is about 30% of its economy. It's huge. And Evergrande's one of the biggest property developers, and we're finding out now that they have these dollar-denominated loans, they have yuan-denominated loans, and the big question everyone is asking is this a one-off event, or is there more to come? Well, what we're finding out today, there must be more to come, because rumors coming out of China say Beijing is stepping in. Let's continue the story because it has just really a lot of interest here, and Evergrande declines further after the S&P says default is likely. So again, remember, when ratings get downgraded, banks have to hold more collateral against this debt, and investment grade strategies or high yield strategies, they have to deal with these downgrades in terms of what their investment profiles are. And here we go. So China Evergrande Group slid deeper into equity and credit markets Tuesday, feeling concerns about broader contagion after the S&P Global Rating said the developer is on the brink of default. The distressed developer share in Hong Kong tanked about 7%. Just before somebody came in and bought it. But they believe Beijing would be compelled to step in if there's far-reaching contagion causing multiple major developers to fail. And that is the real key issue, is this just a one-off issue with Evergrande, or are there more companies that are doing the same thing and effectively running Ponzi schemes where they're starting to build things, selling them, and not having the cash flow? So they're using the money they get from new purchases to pay the interest on their debts. That is the issue. Just how big is a Ponzi scheme in China's real estate market? Well, we don't think Beijing wants anyone to find out, and because that could pose systemic risk to the economy, according to an S&P report. So further on, their fear is, of course, this would lead to a global selling in risk assets, and nobody really wants that. Now let's fast forward a day. So Evergrande filing on yuan bond interest leaves analysts guessing. Now this is important because what happened earlier this week is they missed payments on their dollar-denominated debts, but they said they're going to make payments on their yuan-denominated debts. And just so you understand what's going on here, they can actually borrow in dollars or local currency. So they borrowed in dollars. Now, why would they do that? Well, if you were them and you believed that the dollar was going to lose value, well, you would want to take out dollar-denominated loans because that means your repayment costs would go down as the dollar goes down. It makes a lot of sense. But if you understand how QE works and that it's tightening up financial conditions by trapping dollars in the commercial banking system with the intent to push the dollar up, well, if the dollar starts to rally, those borrowing costs go even higher. And that is the issue here. So they said, we're going to make the payments on the yuan bonds, but let's see how bad the situation is with dollar bonds. So China Evergrande injected a fresh dose of uncertainty into financial markets on Wednesday, issuing a vaguely worded statement, which is usually the best kind of statement to issue on bond interest payment that left analysts grasping for details. Evergrande's onshore property unit said in an exchange filing that interest payments due September 23rd, which would be tomorrow as time of recording, on one of its yuan-denominated bonds has, quote, been resolved via negotiations of the clearinghouse. So that means they're going to either make payments or restructure it. But that fueled speculation among some analysts that the developer struck a deal with local bondholders to postpone the payment without having to label the move a default. Hey, that's a pretty small move, because here's their interest payment schedule. And note in black, these are in dollar-denominated loans. In pink, that is local bonds. And you can see they've been borrowing a massive amount of money in dollars, and that's a problem. because again, if the dollar were to rally, so it looks like they're trying to get an extension on their yuan debt to try to buy some time. Now, here you can see again some of the interest rates on these dollar debts. You can see 8.25%, 13%, 12%, 11.5%, and how many millions in dollars they owe, which is a ton. They owe a bunch of money in dollars, which means, again, they'll need to get dollars. Dollar goes up, they'll have to sell more yuan and exchange it for dollars. And that's the problem, because what has the PBOC decided to do? Well, so far they've just injected liquidity into the banking system, and that's it. And in fact, it looked like there was going to be no bailout at all. But the issue is very serious, because if you look at the ratio of property prices to household income in select cities, you can see that it's going higher. And that, again, is a problem for Beijing, who wants everybody to have access to property there. And these prices are spiraling out of control into the less affordable range. And even Goldman weighed in on this, saying, look, we see some problems here if Evergrande unwinds, that it could have three negative effects. There's three scenarios, one being a little bit, the next one being worse, and then really bad, where new starts, completions, sales volumes, and everything else goes down. And again, keep in mind that real estate is 30% of China's economy. So you can see how serious this is. And the only question remained was, would we get a bailout? Well, no. Looks like we're going to get a breakup. Check this out. This just came out before recording. Imminent China Evergrande deal will see CCP take control. Sources close to Chinese government have told Asia markets a deal will see China Evergrande restructured into three separate entities is currently being finalized by the Chinese Communist Party and could be announced within days, perhaps coincidentally, given the fact that it has a dollar-denominated bond interest payment due tomorrow. State-owned enterprises will underpin the restructure, effectively transforming the property developer from a public company into a state-owned enterprise. Quote, the deal is being designed to protect Chinese nationals who have bought apartments from Evergrande, like the ones you see protesting on the streets. Hey, and some people said that this would happen, that the last thing China wants is an uprising. Well, maybe there's some truth to that in this article here. And then also those who have invested in Evergrande's wealth management products. So, hey, you could lose money both ways, right? You bought an apartment that's unfinished and you invested your money. That's great. But the big thing is stemming, quote, any widespread economic flow on the effects an insolvency would cause on the China economy and really the global economy. So talk of a government-led restructure comes as the Thursday, September 23rd deadline looms for an $83.5 million interest payment on a 5-year U.S. dollar-denominated Evergrande bond. The bond's initial size was around $2 billion. So a very serious issue, but it looks to be that, again, no bailout, but how about a breakup? Now let's talk about the Fed, because today was a big meeting. Of course, every Fed meeting appears to be a big deal. And the issue today was that there was belief that the Fed would announce a schedule to taper, likely to start in November. Well, they didn't do that at all. Let's take a look at what the Fed did, and then we'll talk about what's going on. Here we have the FOMC statement. The only interesting part of it, in terms of a balance sheet taper, because nothing really changed, is last December, the committee indicated that it would continue to increase its holdings of Treasury securities by at least $80 billion per month and agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward its maximum employment and price stability goals. Now, it's price stability meaning its inflation target of 2%. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may be warranted. Well, as we get into the press conference, we're going to get into more of, there's another thing that showed up here that they didn't really talk about. But so what did we learn in the press conference? That Powell said many of the FOMC members thought we had made progress toward the employment goal, and many others actually felt that we were really close to it. And they also felt they were already hitting their inflation target, because we know it's over 2%, and they feel it's going to come down to around 2.1 to 2.2%, and they believe it will hold over their goal. So now we are led to believe that in November, which is the next meeting, that we will hear them announce a balance sheet taper that will likely start in 2022, probably would be in January. And then Fed Chair Powell, when pressed, said that the most members expected a gradual, keep in mind, gradual tapering that would end mid-2022. So in 6 months, they expect to go from $120 billion a month to zero. Of course, I don't think they're actually going to do any of that. I think by then it'll be too late. But if you think about what happened for Powell, it now looks like he is going to be the next Fed chair because there isn't a meeting till November, so there will not be a balance sheet taper this year. The Biden administration is running out of time to notify him that he is out because they have to start a process to find someone new. Now it's largely believed that that new person is already on the FOMC board, but still there's a process that needs to occur. At this rate, it is likely that Powell will keep his seat. And by that, we know he did not want a balance sheet taper because if the economy were to roll over, which we're seeing early signs of as all the fiscal stimulus goes away, he would take the blame and get pushed out. And of course, he doesn't want that at all. So the issue that was brought up in the press conference was employment. And again, they feel that they're very close to this. And part of the reason is the JOLT survey, Job Openings and Labor Turnover Survey, says there's about 11 million job openings. We just had 12 million people on unemployment. Now, granted, that number never ever goes to zero, but they believe that in the next couple of months that a vast majority of those jobs are going to be filled. That is their expectation. Now, we'll actually see what's going to happen because tomorrow, which is Thursday, we will actually start seeing the first initial claims, unemployment claims, without the fiscal stimulus in play. And so the question will be between now and the November meeting, which is the 2nd and 3rd of November, what does the labor market look like? Because that is at this point the only thing the Fed seems to care about. But they also think things are getting worse. Let me show you. Because here we see the decisions regarding monetary policy information. And if you just looked at this, you would see that really there's not a whole lot there unless you closely examine and notice that, hey, there's a statement to revise the terms of the overnight reverse repurchase agreement. There is? Oh, yes. And so they raised the overnight repurchase operations to a per county party limit of $160 billion a day from the current level of $80 billion. They doubled it. And why is that? Because quantitative easing suppresses rates and causes savers to hold cash instead of actually investing their money out in other instruments. That causes cash to continue to build up into the financial system, and that puts low downward pressure on short-term interest rates, potentially because they're so low, driving them below zero. Now, that being a problem because quantitative easing now is not going to stop, at least until, or at least slow down until next year at the best, meaning there's going to be a continued buildup in cash until the Treasury can actually issue some debt and take some of that pressure off. So what does Powell have to do? Increase the overnight reverse repo limits, knowing more cash is building up in the banking system. And what does that mean for rates? Because it's really the question here is, you start looking at the bigger problem is they want to get out of QE. They've never run a QE longer than 2 years, ever. And they're nervous about it because when you see interest rates go down, it tightens financial conditions. And what are we looking at now? Well, let's just see. Here you have the overnight reverse repurchase agreements. I thought I turned tooltips off. Apparently not. Against 30-year Treasury yields in red. And what do we see? As the overnight reverse repo went up, it's putting downward pressure on 30-year yields. They're sitting at a massive support line. If you're a technical analyst or like technical analysis, you can look at 30-year yields and see they're sitting on a big leg of support, getting ready to break lower, sending them down to around 1.6% as the overnight reverse repo goes up. And the Fed has now signaled that their expectations are that is going up. So if you're on the short end of the curve or the long end of the curve, you can expect the short end to stay low near zero and the long end of the curve to go down. How about from the monetary base? Because as the Fed continues to do quantitative easing, their balance sheet expands, and that shows up in the monetary base. So I've taken the monetary base and inverted it against 30-year Treasury yields. And what does that tell you? That the likely path for yields is lower. That means financial conditions will tighten. That is not something the Fed wants. That was usually signals a potential risk-off move for stocks as people who are short the bond market, either as retail customers or as speculators who are actually shorting and betting against higher or lower interest rates, lose out, driving rates lower, pulling money out of the equity market at a time when liquidity is not that strong, because what is the likely driver of stock prices is coming clear that the fiscal stimulus had a big play in it. But that did not deter retail investors who came in just the other day on the dip in stocks and came in and bought that dip aggressively, as they have been conditioned to do every time, believing that the Fed somehow has this magic ability to drive stock prices up. Let's continue on into the economic data, because what do we have? We have building permits heading higher, 6%, suggesting that builders are getting more optimistic in the housing market. And housing starts, they were up to 3.9%. Let's head back over to Bloomberg, and we see residential starts rose 3.9%. And that will help actually create more construction jobs. And where is all the growth coming from? And multifamily starts, which tend to be volatile, increased 20.6%, which is huge. Meanwhile, single family starts decreased for a second month in a row. And so the data suggests that builders are struggling with limited availability of land, labor, and materials. Well, they should have a whole bunch of labor as unemployment benefits are gone. And we're seeing the reports saying the backlogs continue to climb, with the number of single-family homes under construction but not yet completed rising to the highest since 2007. So are we potentially seeing a buildup of a housing crisis? Are people going to come in and buy homes? That is the question. If you build it, will they come? Well, the builders think they will. And if we look at the mortgage Bankers Association Purchase Index, it shows that people are taking on new mortgages, that there's a demand for it. In fact, if we zoom out to the max, you can see that other than, we hit the pandemic and then it kind of faded down, that there's seemingly a resurgence in demand for new purchase. And then this can be on a resale market or a brand new home for mortgages. The question is, does this trend continue? Because overall, we're seeing a slowdown in this space. And then we come back to the University of Michigan home builder sentiment way up here. We see that home builders wanting to build, believing if you build it, they will come. Buyers saying, hey, not interested, prices are too high, can't afford it. The question is, who is going to be right? And then we have the existing home sales came in down month over month, down 1.5% year over year, finally trending back into normal ranges, although it's still elevated, but still back into normal ranges. And of course, we've got a 20-year bond auction we'll come back to in a moment. I want to talk about today's crude oil report, which came out with was strong. Crude oil inventories went down 3.5 million barrels. However, gasoline stocks were up 3.5 million barrels. The question I'm asking, are we seeing now an issue in gasoline? Because my insiders in the industry tell me gas prices are going to head higher, and we already know that people do not have the money to afford it. The question is, if they go higher, will consumers absorb it, or will they start driving less because they don't have the money, and that will constrain their spending in other areas and lead to a disinflationary or deflationary move as people turn to savers from spenders? Well, that was a worry the market had a little bit today about gasoline inventory, but otherwise, gas inventories, distillate inventories, product inventories remain below their 5-year averages. Now let's head over to, before we end up in the bond market, because again, we are sitting on the racetrack, of course. We head over to the Philly non-manufacturing business outlook survey from the Fed, and you would expect to see the services sector trend higher, but we're seeing the diffusion index go lower. What does that mean? It's expanding at a slower rate. And let's look into the details, because it's not all that great. We said, what is your general assessment of business activity for the region? Only 9.6% of firms reporting an increase a net increase. How about general business activity? 21% of firms saying there's an increase, 22% down. New orders, only about 15% of firms. Sales, down. Only 17% of firms saying an increase. Unfilled orders, that's a problem. You want to see inflation, you need to see unfilled orders going up. Only almost 9% of firms saying there's an issue. Their inventories dropping. So that's interesting. Prices paid holding the same. So they're holding prices pretty good. Half the firms said they increased their prices, but check this out. Number of firms were getting higher prices. Well, only 21% of firms, down from 26. So there's an issue there. Although they are hiring full-time and part-time, more firms, 13 and 14% respectively. Average work week slowing down a little bit. Wages, 42% of firms showing an increase. But how about the 20-year bond auction came in with a yield of 1.75%, was very strongly received, mainly due to what I believe is the standing repo facility. And what will that do with inventory? We head over to, again, the New York Fed here, and we see that the inventory of bonds at dealers in the 20 and 30 inventory is dipping down. But what is the big issue here? Why is this indeed bond bullish? Why are we got the crown back on? Why are we at the racetrack? Because 30-year yields are about to break support, and here's a good reason why. Dealers took $4 billion in that auction. $4 billion. The Fed is purchasing $5.7 billion of 20-year loan per month. And what does that mean? They're going to the banks and doing QE at $5.7 billion of 20 years. That means the banks need to have $5.7 billion of 20 years. If they don't have it, where do they go? They're going to go to the dealers, which they own. A lot of them are owned by banks. And if the dealers only have $4 billion, now we saw they have more, but just go with this. Where do the dealers have to go to get the other inventory? The open market. And that's why you see downward pressure on yields. It's why you're seeing things about to break out, because the Fed is continuing with QE at a point where they really want to stop, because they're afraid if the market heads lower, or if the economy heads lower, they don't have the policy mechanism to stop it other than going to QE infinity, and all that is really bullish for the kingdom. Anyways, we'll see you back on Friday for the show. Thanks for being fans. As always, thanks for watching, and we'll be, of course, waiting to find out if Beijing announces a breakup for Evergrande. I'm Steven Van Metre. Bye now. The content of this video is provided as educational information. It's not intended by investor or other advice. Materials not to be construed as regulatory solicitation by our Social Security, financial instrument, or participate in particular trading strategies. This video is prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the views of Atlas Financial Advice Inc. or Steven Van Metre Financial.